Bitcoin's price volatility isn't a bug, it's the entire thesis. The same properties that make it useless as a medium of exchange, slow settlement, wild price swings, no intrinsic yield, are what turbocharge its speculative appeal. This isn't money. It's a crowdsourced hedge against monetary decay. The data reveals a brutal truth. BTC's 10-year annualized volatility is 3.5x higher than the S&P 500, yet its correlation to traditional assets has collapsed to near zero since 2020. Institutions don't buy it despite the volatility. They buy it because of the volatility. When every other asset is drowning in liquidity-driven correlations, BTC's dysfunction becomes its superpower. The 5 hidden forces propping up Bitcoin's value. 1. The greater fool premium. 87% of BTC trades occur on derivatives exchanges, Binance, Bybit, OKX. Retail isn't using it to buy coffee. They're levering up to chase asymmetric payoffs. Open interest in BTC futures just hit $38 with perpetual swaps funding rates averaging 0.01% per hour. This isn't adoption. It's a global casino. 2. The Tether carry trade. 60% of BTC trades are against USDT, not USD. Tether's $112 balance sheet, backed by, creates artificial liquidity that props up the entire crypto ecosystem. When this breaks, and it will, BTC's store of value narrative implodes. 3. The ETF feedback loop. BlackRock's IBIT holds 300,000 BTC, $20 BAUM. Every $Lu creates a supply shock, but also turns BTC into just another ETF ticker. The more legitimate it becomes, the more it loses its anti-establishment edge. 4. The energy arbitrage. Miners consume 127 terawatt-hours per year, more than Norway. This isn't waste, it's a feature. The energy burn acts as a proof-of-work tax that sustains scarcity. If BTC ever transitions to proof-of-stake, its value proposition collapses. 5. The regulatory capture play. Coinbase's stock is up 400% since 2023, not because of retail trading fees, but because it's becoming the only compliant on-ramp for institutional capital. The SEC's crackdown on competitors is the best thing that ever happened to BTC's price. Why Warren Buffett hates Bitcoin and why he's wrong. Buffett's infamous rat poison squared comment misses the point. BTC isn't competing with Berkshire Hathaway, it's competing with central banks. The USD has lost 98% of its purchasing power since 1913. BTC's fixed supply is a direct attack on fiat debasement. Gold's market cap is $15 T. BTC is just $1.3 trillion. Even a 10% portfolio shift from gold to BTC implies a 10x price increase. But here's the catch. BTC will never be digital gold because gold has industrial uses and 5,000 years of trust. What BTC does have is something far more powerful, a cult-like belief in its inevitability. The coming liquidity crisis and how to play it. The Fed's reverse repo facility still holds $600 in excess liquidity. When that finally unwinds, risk assets will crater, including BTC. But the rebound will be even more violent than 2020. 2025 price prediction, $25 liquidity crunch, right pointing arrow $150, Fed pivot, right pointing arrow $50, long-term equilibrium, the smart play, sell volatility via BTC options. The 25% implied volatility premium is free money when you realize BTC's true beta is to liquidity conditions, not adoption. Final verdict, hold but don't HODL. BTC isn't an investment. It's a trade. The moment you forget that, the moment you start believing the digital gold or hyper-Bitcoinization fairy tales, is the moment you get wrecked. The smart money isn't buying BTC for the long term. They're front-running the greater fools.